There you have it, the closing bell at the New York Stock Exchange, ending another week on Wall Street. The Dow Jones had an up and down day, but ended the day in green, up more than 100 points. You hear that clapping. The S&P 500 also stayed relatively flat, up about 0.5%. The Nasdaq dropped around 0.25%.
We're going to bring in John LaForge, head of real asset strategy at Wells Fargo Investment Institute. John, kind of a flat day on the market here. What, if anything, was driving the exchanges?
Yeah, I'd say generally it wasn't an eventful day for stock markets, but it was for my area. So oil, as an example, there was a Saudi oil field that was attacked. So oil at one point was down $2 and rallied $2 into the end of the day. But for the stock market, I'd say generally it is the Russia-Ukraine events that's really driving everything at this point. It's either, depending on the mood, or either risk on or risk off.
And talking about oil, John, why is it that Russia, accounting only for a small percentage of imports in oil, is having such a big effect on inflation here in the U.S.? It's some people say it's as low as 3%. And why is it that the U.S. can't produce more oil to counteract our ban on Russian imports?
Yeah, in terms of the U.S., we consume about 20 million barrels of oil a day as a country. We only import from Russia about 500,000 barrels a day. So it's a relatively small number, but commodities are global. So if you're going to remove supplies from one area, you have to somehow fill that gap. So it almost doesn't matter how much the U.S. imports from Russia. If Russia is suddenly just shutting off the tap, we have to figure out as a world how to get that other country either oil or food and so on. As far as the U.S. and why we're not filling the gap, it's a very different dynamic with the U.S. With the U.S., the investors are essentially telling U.S. oil producers, be disciplined, don't overdo it. And a lot of that has to do with environmental concerns. Policies in the U.S. are dramatically moving towards anti-fossil fuels. And because of that, oil producers are a little hesitant, and their investors are telling them, hey, tap the brakes. We know you can make a lot of money, but we don't want you overproducing fossil fuels.
Now, today, President Biden vowed the U.S. and Canada will help provide more wheat to Europe to alleviate the impact of sanctions against Russia. But how much can the U.S. and other countries actually fill in these trade gaps, and how long does that take? Crops don't grow overnight.
They don't. One kind of, let's call it overlooked area is the stocks that some countries do have. So yes, there is a gap that needs to be filled, particularly in the Middle East, which are big importers of food and grains, in North Africa. Many of those countries have stores, though. So what tends to be overlooked is many of them, take Egypt as an example. They're a big importer of wheat, but they have 4 to 5 months worth of stocks that they can burn through before they have to go on the market and buy. Still not a great situation. I don't look at it and say, ooh, phew. So in the end, the gap can be filled by some of these other countries. The bigger grain producers are the U.S., Canada, Brazil, Argentina, and they're doing what they can to fill the gap. But the longer this standoff keeps happening in the Ukraine, the tougher it's going to get. So today I'd say we're not hitting the red button yet, in terms of level. We're kind of working into the orange, though, so we need to be careful.
John, what about underdeveloped countries, or developing countries, I should say, that maybe don't have that stockpile of wheat? How much harder are they going to be impacted when we look at this geopolitical crisis in Ukraine? We're focusing a lot on gas prices here in the U.S., as we should be, but I'm also thinking about people in countries that are even worse off.
Yeah, and it's going to be brutal for some. Take Somalia as an example. They don't have any stores. They don't have any grain stores, so they have to keep buying on the open market. And frankly, when you look at commodities specifically, they tend to be priced in U.S. dollars around the globe. We don't think much about that as Americans, but if you're in another country, you do, because the U.S. dollar this year has been very strong. We opened the segment talking about the stock market. it's been kind of a choppy year, down a little bit, because a safety bet is on. So the US dollar rises. That means if you are one of these countries buying a commodity, because it's priced in dollars, you're using your own currency, which tends to be a little weaker if the US dollar is higher. So it's even worse for some of these countries. It's not just we can't get the supplies, it's just the prices have gone up to fill that gap, and then they've gone up a whole nother level because their currencies don't keep up with the US dollar.
Right. The repercussions of this war are being felt all over the world. John LaForge, thank you so much.
Thank you.